The Department of Mineral Resources and Energy has announced that petrol 95 unleaded will decrease by 1 cent per litre, whilst 93 unleaded will increase by 2 cents from today. Diesel cost 73 cents a litre less, whilst illuminating paraffin went down by R1.24. Now, in a statement, the department says that LP gas is 92 cents per kilogram less. Some economists are concerned about the impact of the recent higher oil prices on the inflation outlook. Oil prices jumped 7% this week to above $85 per barrel. Meanwhile, on the macroeconomic front, Saudi Arabia and other major oil producers on Sunday announced surprise cuts totaling up to 1.15 million barrels per day from May. It's a move that could raise prices worldwide. So perhaps to further unpack this and what it means on the markets, we're joined via Zoom by Isaiah Mhlanga. He's the head of research at Merchant Bank. Isaiah, good afternoon. Thank you for your time here on the SABC.
Good afternoon for having me.
Isaiah, the price adjustments for April, does it offer any reprieve? 95 unleaded decreasing by 1 cent per litre, 93 unleaded increasing by 2 cents per litre?
Indeed, it's very marginal. The major drivers of that has been the moderation in oil price from about $82 per barrel to $79 per barrel. So just about $3 decline in the price of oil in dollar terms. But on the other hand, we also saw a depreciation of the rand by just under 30 cents from 17.74 to just over 18 rand per dollar. That essentially negated some of the positive impacts of the decline in oil price. But we also had announcement in the budget earlier on that said the road accident fund, the fuel levy are not going to change for this year, and that's going to provide a reprieve. This being April, the beginning of the new financial year, the fiscal year for National Treasury, which means it's not going to filter through into price, so there is some reprieve. But if we just look forward, given the announcement of OPEC plus countries to cut production by over 1.16 million barrels per day, in addition to the ones that have already been announced last year, taking the total production cuts to 3.36 million barrels per day. We saw markets reacting from just about $80 per barrel to about just over $85 per barrel. It's not significant. We had already in our inflation forecast priced in an average of $90 per barrel in the second half of this year, which means it's not going to change our inflation forecast. But for consumers, obviously it's going to be painful given that oil prices are going to eventually filter through into higher fuel price. So what we are seeing now is going to be completely reversed, and we're going to see slightly more higher fuel price going forward.
Isaiah, thank you for giving us context on a micro level and a macro level. And I actually want to zoom in on the macroeconomics behind it all, and also look at the influence of the geopolitics at play. When we look at what, Saudi Arabia's stunning decision to cut the oil production, this obviously announcing significant cuts in their oil production, which now begins in May. Was this unexpected?
Yes, we did not expect it, especially given that it was announced outside of the OPEC structure. Essentially, Saudi Arabia went unilaterally and announced, and other OPEC countries followed suit. So it was not expected. But if we consider the global macro environment where economic growth is expected to be much weaker in the US and in Europe and in the UK, essentially meaning there's going to be less demand for oil. But on the other hand, we have the China reopening story, which is going to gain momentum in the second half of this year, which almost balances out the decline in demand from the US and Europe, which means these cuts that we have seen, it was in anticipation for reduced demand. So the oil producers tried to front run that process and cut production to bring the demand and supply environment into balance. But so far, we have not yet seen a significant response in the market. It has been about 7% increase, which we think it's still quite limited but the outlook shows that we are likely to see higher oil prices into year-end and into 2024.
Isaiah, looking at some of the other contributing factors, is it correct in assuming or looking at, you know, these cuts coming amidst tensions between the US and Saudi Arabia? We saw President Joe Biden obviously making a state visit last year, and his request to increase oil production was rebuffed. I'm also asking this because the decision to drop crude prices also affected, which caused some turmoil, which was caused by turmoil in the banking sector, rather, also impacted Saudi Arabia. So perhaps this was a way for them to safeguard themselves. How would you weigh up and explain those dynamics unfolding?
Well, I think it's quite obvious that geopolitics is playing a part.
Yeah.
But also, it's quite important for us to recognize that the cuts in oil production are happening at a time when U.S. crude oil reserves are at an all-time lowest, which means the U.S. does not have the capacity to respond by releasing those strategic reserves into the market to reduce the oil price. So there is a constraint on the U.S. part as far as responding to these cuts are concerned. So it just means we are going to continue to see tensions geopolitically, but also we have seen a number of emerging markets that have touted to trade in their own currencies, essentially reducing the amount of trade that they do, using the US dollar. And that is just an escalation of geopolitical tensions that started a number of years ago, but it's not going to result in a significant reduction in the use of the US dollar at the moment. Remember, about 60% of global trade still happens using the US dollar as a counterpart, and that is going to remain the case for some time. But surely there are some shifting, currencies underneath where countries are trying to cushion themselves by reducing their dollar use.
As I just in conclusion, I wanted to then look at what opportunities lie for the US, given this unexpected announcement, perhaps also for BRICS nations. And, whether we can at this point predict exactly how badly this decision is going to affect pockets for consumers alike.
Look, for consumers, it is a negative. Higher prices of oil mean higher fuel prices. Energy prices in general tends to be a knock on household pockets. But if we look more broadly, there aren't any winners in tensions. We saw it when the Trump administration imposed taxes or tariffs on Chinese trade. China retaliated to the detriment of the global economy. Even now, we are likely to see a negative impact of these geopolitical tensions that are escalating. It is not anything that we can actually say is going to result in a positive boost to any of the economies that are involved. It's quite negative for the global economy, also negative for the US, negative for Europe, negative for all countries, including emerging markets like South Africa.
As I thank you for your time here on the SABC. As I'm Klanga, head researcher at Merchant Bank.